These are 11 nations who control 48.5% of the world's population and 39% of global GDP, and they're systematically dismantling the foundation of American economic power through coordinated de-dollarization. This is the story of how BRICS could trigger a U.S. financial crisis in the next 12 months. The numbers paint a stark picture. The U.S. dollar's share of global foreign exchange reserves has plummeted to 56.3% in 2025, the lowest level since 1994. That's a staggering collapse from 70% in the year 2000. We're witnessing the slow-motion death of dollar dominance, and it's accelerating faster than most Americans realize. But here's what makes this different from previous challenges to American monetary power. This time, there's an organized alternative waiting in the wings, backed by institutional frameworks that didn't exist before. BRICS originally included just Brazil, Russia, India, China, and South Africa. Now it's expanded into a formidable economic bloc that includes Egypt, Ethiopia, Indonesia, Iran, Saudi Arabia, and the UAE, with partner countries like Malaysia, Nigeria, Thailand, and Vietnam also joining the movement. We're looking at a coordinated effort involving nearly half the world's population. The expansion isn't just about numbers. It's about resources, energy, and most importantly, a shared determination to break free from what they see as American financial imperialism. When Russia's finance minister, Anton Silvanov, announced in November 2025 that Russia and China now conduct 99.1% of their trade in national currencies, completely bypassing the dollar, he wasn't just sharing a statistic. He was declaring independence from the system that has underpinned American global dominance for 8 decades. Saudi Arabia's inclusion in BRICS represents perhaps the most significant blow to dollar hegemony since Nixon's 1971 decision to abandon the gold standard. The 1974 petrodollar agreement between the US and Saudi Arabia created the foundation of modern dollar dominance. Saudi oil sales, in exchange for dollars, recycled into U.S. Treasury securities. Now, the kingdom is actively exploring yuan-denominated oil sales and has joined an organization explicitly designed to circumvent the dollar system. This is the unraveling of the petrodollar architecture that has guaranteed American economic supremacy for 5 decades. Consider what's happening in the gold markets. BRICS plus central banks added nearly 800 metric tons of gold in 2025 alone. Their combined reserves now exceed 6,000 tons, roughly 20% of all central bank gold holdings worldwide. Russia holds 2,336 tons. China has 2,298 tons, and India possesses 880 tons. This isn't random accumulation. It's strategic positioning for a post-dollar world, driven by what economists call the Triffin dilemma, the inherent contradiction that any reserve currency must run trade deficits to supply global liquidity, ultimately undermining its own stability. The market has taken notice. Gold prices surged to approximately $4,400 per ounce in late 2025, driven partly by this central bank buying spree. But more telling is what the World Gold Council's 2025 survey revealed. 73% of global central bankers believe the U.S. dollar's share in global reserves will decrease over the next 5 years. When the people who manage the world's monetary reserves are betting against your currency, you have a problem. The technical infrastructure for dollar alternatives is rapidly coming online. China's cross-border interbank payment system now connects nearly 5,000 banking connections across 121 countries through direct and indirect participants. In late November 2025, Standard Bank, Africa's largest by assets, became the first African bank to link directly into CIPS. This allows African businesses to settle payments with China in renminbi without using any intermediary currency. Meanwhile, the mBridge project, a joint central bank digital currency initiative involving China, Thailand, and the UAE, provides another pathway for cross-border settlements that completely bypass the dollar-dominated SWIFT system. This matters because it breaks the dollar's monopoly on international transactions. For decades, even if two countries wanted to trade with each other, they often had to convert their currencies to dollars first. CIPS, M-Bridge, and similar systems are changing that fundamental reality. Then there's the unit, BRICS answer to the International Monetary Fund's special drawing rights. Launched as a pilot program in October 2025, the unit uses a 40% gold backing combined with a 60% basket of BRICS currencies. This isn't just theoretical anymore. It's a working prototype that adjusts daily and provides a concrete alternative to dollar-denominated transactions. More importantly, it's backed by the new development bank, BRICS institutional alternative to the World Bank and IMF, which has already committed over $30 billion in infrastructure financing across member nations. The geopolitical catalyst accelerating this process, Donald Trump's tariff threats. When Trump declared in January 2025 that any country aligning with BRICS would face 100% tariffs, he intended to intimidate. Instead, he may have triggered the very outcome he sought to prevent. Brazilian President Lula's response was swift and pointed. "We don't want an emperor, we are sovereign countries." Trump's threats have created what international relations experts call a wounded hegemon scenario. When a dominant power feels its position threatened and responds with aggressive measures, it often accelerates the very trends it's trying to stop. The tariffs aren't just economic policy. They're forcing countries to choose sides in a way that makes dollar alternatives look more attractive, particularly when combined with China's Belt and Road Initiative, which has already committed over $1 trillion in infrastructure investments across BRICS-aligned nations. The fiscal backdrop makes America's position even more precarious. U.S. federal debt reached $36.2 trillion in 2025. That's 119% of GDP and growing at an average rate of 8% annually. The interest burden alone consumed 18.4% of government revenue by April 2025, totaling $579 billion. The Congressional Budget Office projects debt will reach 107% of GDP by 2026, climbing to a record $35 trillion. These aren't abstract numbers. They represent a structural vulnerability that foreign creditors are beginning to exploit, illustrating perfectly what economist Robert Triffin warned about in the 1960s. Any country providing the world's reserve currency must eventually choose between domestic stability and international liquidity. Foreign investors, who once held over 50% of U.S. Treasury securities during the global financial crisis, now hold just 30%. They're diversifying away from dollar assets at precisely the moment when America needs them most. The parallels to Britain's loss of reserve currency status are striking. In 1948, the British pound accounted for twice the global reserve share of the dollar. By 1969, the dollar had overtaken it tenfold. By 1980, the pound had declined to just 2% of global reserves. What took 3 decades then could happen much faster in today's interconnected world, especially given that Nixon's 1971 shock demonstrated how quickly monetary regimes can collapse when confidence breaks. Energy markets are where this transition becomes most visible and dangerous for the dollar. Russia and China's energy trade has surged past $250 billion annually, all settled in rubles and yuan. Brazil uses reals and yuan for soybean sales to China. India and the UAE trade in rupees and dirhams. China has settled liquefied natural gas deals with the UAE in yuan. These bilateral arrangements are creating a parallel financial ecosystem that operates independently of dollar-based infrastructure, systematically eroding the petrodollar system that has been the bedrock of American monetary dominance. The Trump administration's response has been to double down on threats. In July 2025, additional countries received letters threatening 50% to 100% tariffs. But this approach is backfiring spectacularly. Countries that might have remained neutral are now actively seeking alternatives. Indonesia's foreign ministry, after initially showing interest in BRICS currency initiatives, backed away following tariff threats. But that backing away was tactical, not strategic. The underlying drive toward currency diversification continues. What makes the current moment particularly dangerous is the convergence of multiple crisis vectors. We have unprecedented U.S. debt levels, accelerating foreign divestment from dollar assets, rapid development of alternative payment systems, and a geopolitical environment that's pushing neutral countries toward the BRICS camp. Any one of these factors alone would be manageable. Together, they create the conditions for what economists call a sudden stop, the moment when foreign capital flees so rapidly that it triggers a broader financial crisis. The stablecoin paradox adds another layer of irony. About 99% of stablecoin market capitalization, now over $220 billion, is linked to the dollar. Cryptocurrency was supposed to create alternatives to government currencies, but instead, it's created new forms of dollar dependence. If dollar confidence cracks, the crypto markets that many see as alternatives could amplify rather than cushion the fall. The Federal Reserve's position becomes increasingly untenable as this process accelerates. Maintaining dollar strength requires higher interest rates, but higher rates make the federal debt burden unsustainable. Lowering rates to help with debt service accelerates capital flight and dollar weakness. It's a policy trilemma with no good solutions, a manifestation of the same Triffin dilemma that ultimately brought down the Bretton Woods system. Recent market behavior suggests confidence is already cracking. Traditionally, Middle East conflicts drive flight to safety, buying of dollars. But during the recent escalations, the dollar barely moved. That suggests international investors no longer view U.S. assets as the automatic safe haven they once were. The 12-month time frame isn't about BRICS launching a fully operational alternative currency. That's still years away. It's about the accumulation of pressures, reaching a tipping point where market confidence in dollar stability breaks down suddenly and decisively. If financial markets operate on confidence and momentum, once a significant shift begins, it can accelerate far faster than the underlying fundamentals would suggest. Consider what happens if even one major crisis hits in the next year. A debt ceiling standoff that damages Treasury credibility, a major bank failure that reveals dollar funding stress, or a geopolitical conflict that forces rapid BRICS cooperation. Any of these could trigger the kind of sudden capital flight that transforms a gradual decline into a financial crisis. The Congressional Budget Office's projections show the dollar's reserve share potentially falling to 45 to 50% by 2055. But that assumes a gradual, managed decline. Market-driven collapses don't follow neat 30-year timelines. They happen in months or weeks once critical thresholds are crossed. We're watching the unwinding of the system that has guaranteed American prosperity since World War II. The Bretton Woods Agreement that established dollar hegemony was signed when America represented 50% of global manufacturing and held most of the world's gold. Today, America represents less than 20% of global manufacturing, runs massive trade deficits, and its main export has become the dollars themselves. The BRICS nations represent a return to what international relations scholars call a multipolar world, one where no single currency or country dominates global finance. For Americans accustomed to what French Finance Minister Valéry Giscard d'Estaing called the exorbitant privilege of printing the world's reserve currency, this transition will be painful. It means higher import costs, reduced ability to finance deficits through foreign borrowing, and the end of America's ability to impose its will through financial sanctions. The countdown has indeed begun. Not because BRICS has created a perfect alternative to the dollar. They haven't. But because the dollar's dominance was always built on confidence, and that confidence is eroding faster than the institutions that depend on it can adapt. The question isn't whether this transition will happen, but whether it occurs gradually over decades or catastrophically over months. The next 12 months will likely determine which path we're on.